Look, if you've been trading for any amount of time, you've probably been taught this classic, seemingly foolproof rule. When the RSI indicator pushes above 70, the market is overbought, so you should sell. And when it drops below 30, it's oversold, so you buy. Sounds incredibly easy, right? Well, here is the harsh truth. That exact, oversimplified rule is a massive trap. Honestly, it's the exact reason why retail traders get their accounts liquidated every single day. So in this explainer, we're going to expose the flaws in that beginner mindset and uncover the actual advanced techniques that professionals use to read momentum and truly dominate the markets. Okay, let's dive into this insider playbook. First up, we'll unpack the RSI mistake. Then we'll get into the power of divergence, reading RSI in context, drawing trend lines on the RSI, and finally, we'll bring it all together with multi-signal confluence. All right, part 1, the RSI mistake. It's time to move beyond this whole 70-30 thing. It's just incredibly frustrating, isn't it? You follow the textbook rules perfectly, and then the market decides to do the exact opposite. See, the beginner mindset treats the RSI like a mechanical switch. Hit 70, sell immediately. Hit 30, buy the dip. But the harsh reality, which you've likely felt firsthand, is way more painful. If you follow this blindly, you're going to end up trying to short the exact tops of aggressive uptrends, only to get squeezed out while you watch your account drain. Or you're desperately trying to catch falling knives and brutal downtrends just because the RSI happened to flash 30. Markets just do not operate on formulas that simple. So we need a paradigm shift. We have to redefine what we're actually measuring here. RSI is not some crystal ball that magically predicts tops and bottoms. It is a measure of momentum. Think of it as the speed and raw power of the cash flow behind the price movements. Literally, anyone can look at a chart and tell you if the price is going up or down. But understanding RSI means seeing whether the buying power behind that move is still strong, or if it's starting to dry up. That underlying strength, that's what truly dictates whether a trend is going to keep running or finally reverse. Moving right along to part 2, the power of divergence, and spotting those early warnings of a reversal. Now, this is where things get really exciting. Divergence happens exactly when the price on your chart and the underlying momentum start disagreeing with each other. Let's look at bearish divergence first. The price is pushing up to new, higher highs, but the RSI is actually making lower highs. What does that mean? It tells us the buying power is losing steam. This is the classic footprint of market makers quietly distributing their assets while the retail crowd is totally swept up in peak FOMO. On the flip side, we've got bullish divergence. The price is crashing down to terrifying new lows, but the RSI starts making higher lows. The selling pressure is exhausting itself, and that is exactly when smart money steps in to accumulate during mass panic. But wait, here is a massive trap you absolutely must avoid. RSI divergence is an early warning system. It is absolutely not an immediate signal to just jump right into a trade. In a strong trend, divergence can actually drag on for a really long time before the market finally turns. Professionals know this. They use divergence just to get prepared. They wait for structural confirmation, like a break in market structure or a clear shift in volume, before pulling the trigger. This gives them a massive edge before the rest of the market even realizes what's happening. All right, part 3, reading RSI in context. Let's break that binary mindset for good. To trade like a pro, you have to completely shatter the idea that an RSI number means the exact same thing in every single market environment. It creates this fascinating paradox. A beginner sees an RSI above 70 as a totally guaranteed imminent crash. They see the word overbought and they panic sell. But the professional view? An RSI above 70 and a strong uptrend actually highlights aggressive, highly bullish cash flow. Being overbought in a strong market just means buyers are in absolute control and buying with serious conviction. If you try to short that just because a line crossed 70, you are literally going to get run over by the trend. So forget 70 and 30 for just a second. I want you to burn this specific number into your mind, 50. This is the hidden line in the sand. While beginners are completely distracted by the extreme edges of the indicator, professional swing traders use the 50 level as their ultimate trend filter. If the RSI pushes above 50, bullish momentum is taking over. If it drops below 50, sellers have seized control. It's really that fundamental. See, RSI ranges actually shift completely depending on the context. In a strong uptrend, the entire RSI range shifts up. It'll typically bounce between 40 and 80. So those dips down to the 40 or 50 level, those aren't signs of a crash at all. They're actually incredible continuation buying opportunities. Conversely, in a strong downtrend, the RSI stays totally suppressed, rarely ever passing 50 or 60. Trying to buy when the RSI consistently fails to break above 60 in a downtrend is exactly like standing in front of a speeding train. You simply have to read the indicator within the context of the larger trend. Section 4. Drawing trend lines on the RSI. This is how you spot the shift early. Now, this is arguably the most advanced insider technique we're covering today, treating the indicator itself just like a price chart. Why does this unorthodox method work so well? Because momentum always shifts before price does. Market makers always leave early footprints in the order flow, and because RSI measures that momentum, those footprints are going to show up on the indicator first. You can actually draw a descending trend line directly across the lower highs on your RSI. In a lot of major moves, the RSI will break out of its trend line well before the actual price breaks its resistance. This is the secret that lets professionals position themselves perfectly, way before the actual price breakout triggers that wave of beginner FOMO. And finally, Section 5. Multi-signal confluence. Let's build the ultimate setup. This is where we bring the whole shebang together. Look, no single indicator is magic on its own, but when multiple signals align, that creates what a lot of professionals consider a God setup. Imagine watching this unfold live on your screen. Step 1. The RSI plunges under 30. The retail crowd is in absolute panic mode. Step 2. A bullish divergence appears. Price is making lower lows, but momentum is quietly, stealthily rising. Step 3. You've drawn your trend line on the RSI, and suddenly, boom, it breaks its downtrend line. Momentum is officially shifting. And finally, step 4, the price actually reclaims a key structural support level on the chart. When you have this multi-signal confluence, it is vivid proof that the selling pressure is dead and the smart money has officially arrived. As we wrap this up, I really want you to deeply internalize this thought. RSI doesn't make traders money. How you read it does. So many traders waste endless hours out there searching for a holy grail, stacking dozens of complex indicators on top of each other until they can't even see the candles. But the difference maker isn't the tool itself. It's your ability to understand market psychology, the overall context, and knowing who is actually controlling the cash flow. A single indicator, deeply understood, is infinitely more valuable than a messy chart you barely comprehend. So, I'm going to leave you with this final provocative question. Ultimately, RSI is just a mirror. It's reflecting crowd psychology. Every peak and every trough tells a story of human fear and greed. So the next time you open a chart, you need to ask yourself, are you blindly following the panicked crowd? Or are you reading the momentum to align yourself with the smart money? Keep that in mind, apply these advanced strategies, and go take control of your trading.